everyone. We're going to go ahead and get started. I'd say good morning, since that's what it is here on the West Coast in the U.S. and all over the U.S. But I know many of you are joining us from time zones from around the world. Over 300 of you are joining this discussion, and I want to thank you for taking time to add your thinking to ours on this important topic. My name is David Erickson. I oversee the community development group here at the New York Fed. We're a small group dedicated to finding creative financing solutions to problems facing low-income communities. We recently finished a new strategic plan that will be public soon. The goal we landed on for our work is the following. Within the next 5 years, the Community Development Unit will, 1, elevate 3 groundbreaking ideas or approaches to target the drivers of or barriers to economic mobility for low and moderate income people, especially those facing poverty and or structural disparities related to race or ethnicity. And 2, educate, influence, and catalyze capital providers to invest in creating more opportunities for those groups. And one of those groundbreaking ideas that we're focused on is finding ways to collaborate with those of you who are thinking of new ways to provide climate adaptation financing to marry those efforts with the strategies to finance stronger local economies. As you know, the areas most susceptible to climate risk are often also at risk because of high rates of poverty and other economic factors. I have a few housekeeping notes I want to share. This event is being recorded and will be hosted on the New York Fed's event webpage. As a reminder to the speakers, this event is open to the media, so the remarks and presentations are on the record. All attendees will be in listen-only mode with your video disabled for the duration of the event. The viewing options are on the top right-hand corner of your event screen. For optimal viewing, please try the active speaker view. This will be a 1.5-hour event, webinar, and because of the time constraints, we won't have Q&A. But we will ask for your follow-up questions on the event website after the event. The webinar will begin with opening remarks by Kevin Styro, Executive Vice President of the Supervision Group here at the New York Fed. We'll then have a discussion moderated by Claire Kramer-Mills with 3 leading experts in the field of climate change. Following the discussion, I'll pop back in to give brief closing remarks. Of course, those views are my own and not of do not reflect those of the New York Fed or the Federal Reserve System. Now I'd like to introduce Kevin Styro, head of the Supervision Group. In addition to being a towering leader in the bank supervision field, Kevin is a close ally of the community development work here at the New York Fed. Relevant to this discussion, Kevin is co-lead of the Basel Committee's task force on climate-related financial risk. He has spoken on this topic at Harvard, his alma mater, and the Global Association of Risk Professionals. Over to you, Kevin.
Thanks, David, and thanks for having me here today. Can you hear me okay?
Yes.
Great. Okay, well, good morning, everyone, and thank you all for joining us for today's webinar on climate risk and adaptation opportunities in low-income communities. It's a real pleasure to be here today. The COVID-19 pandemic underscores the importance of mitigating risks from events with potentially severe global consequences. It also illustrates the differential impact that these risks can have on vulnerable communities. So today we'll hear more about the economic and financial risks from climate change and how they may amplify existing inequities across communities. Before proceeding, I'll just emphasize that I'm speaking for myself and not necessarily the Federal Reserve System or the New York Fed. Attention on climate-related financial risks is clearly growing within the financial sector, both for the private and public components. The Federal Reserve, for example, recently discussed these risks from a macroprudential perspective in its Financial Stability Report and from a microprudential perspective in its Supervision and Regulation Report. These reports describe how the economic and financial impact of a changing climate can impact financial firms through increased market risk, credit risk, or operational risk, and how that impact can be amplified by the potential for nonlinear effects, the opacity of exposures, and timing uncertainty. In addition to these broad financial market impacts, a growing body of scientific research is assessing climate risk impact across heterogeneous communities in the United States. The 4th National Climate Assessment, which is a comprehensive report conducted by 13 federal agencies and private sector experts, for example, has concluded that climate change will disproportionately impact low-income communities in both urban and rural areas. The report also highlights the impact of pre-existing health and economic conditions on lowering resilience to climate-related risks. As a result, pre-existing differences may be compounded by climate-related risks and threaten to exacerbate widening economic inequality. Research from Brookings and Stanford, for example, estimate that if climate change-related vulnerabilities are not addressed, Americans in the lowest socioeconomic income quintile will likely face the most significant economic losses. So today's conversation about the impact of climate-related risk on low-income communities is critically important. It's especially pertinent as we confront a global health crisis that is inflicting disproportionate harm on low-income communities and communities of color. Collaboration efforts like this one can enhance our understanding of the financial and economic impact of climate change on low and moderate income communities, and begins an important discussion about climate adaptation practices and investment opportunities. As David mentioned, the New York Fed's Community Development Team will be focusing on these issues over coming years, and we look forward to an ongoing collaboration with all of you. So thank you again for joining us, and I'll turn the virtual floor back to Claire Kramer-Mills. Thanks.
Thanks so much, Kevin, and welcome everyone. Good morning. I'm Claire Kramer-Mills and from the New York Fed's Community Development Team, and it's really my great pleasure to introduce our panel of experts for the conversation. James Vaccaro is CEO of Repattern and Interim Director of the Network and Strategy Team for the Climate Safe Lending Network. Audrey Choi is Chief Marketing Officer and Chief Sustainability Officer at Morgan Stanley. Mijin Cha is Assistant Professor, Urban and Environmental Policy at Occidental College. And today's discussion is going to be wide-ranging because we have at our hands here such an illustrious panel of experts that have really thought about these issues for some time and have varied approaches to how we're going to grapple with climate change in low-income communities. So it's really a thrill to have you each of you here today. Here's how the panel will go. We'll turn to each of the experts in turn and have a bit of an exchange with each of you, and then we'll open the floor and have some general questions. So really excited to start. And to begin, I'm going to begin with James. And Kevin's remarks about climate change touch on a number of risks that we're facing, that financial firms are facing, whether it's credit risk, market risk, operational risk. You've broadened the consideration of risk, and you've done a lot of thinking about really climate change and systemic risk. And so I'd like to begin with your thoughts on systemic risk, how you're thinking about it, how you define it, and specifically how systemic risk may impact low-income communities.
Sure, thanks, Claire. I think the first thing to be precise about is the risk to who. So in TCFD, for example, you have physical risks and transition risks, but that's really through the lens of the financial institution itself. So it's around those risks crystallizing some way on a financial institution's balance sheet ultimately. So from that perspective, that's the mandatory prudential kind of view of how do you keep financial institutions safe from these events in the world. But the flip side of it is the risks for what is it that the financial system may be supporting, which is then crystallizing risks, which may not be financial right now, ultimately will be, but are contributing to these systemic risks. So it's around how do you keep the world safe from financial institutions and the effects and impacts of activities. And these spillovers, so whether or not specific loans, credits, or investments kind of crystallize in particular losses for a financial institution, it creates these the risks we see for society, for nature, for communities, and that ultimately will come back, but not directly onto balance sheets. And also when we look at what do we mean by what does managing risk look like? So in managing physical risks or transition risks, which are the two major categories, we think, well, that must be a good thing. However, the way that, especially within lending sectors, that you might see physical risks being managed is, well, it becomes too difficult to lend to an area because it's underwater or it's on fire or there's persistent drought. So typically banks say, well, we can't really lend anymore. So again, how do you prevent from one hand getting into that position in the first place? It's about managing the systemic contributors through your impacts, which might be causing those floods or those droughts. And likewise, transition risk. Transition risk means not losing out on some of the income revenues from things which might become stranded assets. That potentially can translate into financial institutions trying to squeeze every last drop of revenue out of the kind of things which are contributing to the climate crisis, be it in fossil fuel finance or in deforestation. So it's really important to be able to kind of look at this kind of ancillary part, which is what are the impacts on society and how does that ultimately contribute to or undermine longer term financial stability?
So that's really interesting. And in full disclosure, James, you're a former banker, so you've seen kind of both sides of this, right? I'm curious from your perspective. You know, you've given a great deal of thought to this, and you published work recently with very specific recommendations for financial institutions, and really how they can really be agents of this transition that you're talking about, and stewards of the transition. So specifically, you know, I'd love to get your thoughts on kind of specific actions that financial institutions can take and should be taking at this time.
Yeah, so I think that, I mean, there's been some amazing strides in terms of signaling and making commitments and targets, but beyond the targets comes a really interesting bit. And my last role in the bank was director of strategy. So you've got to pivot from the targets into the strategy. What is it you can do? And that agent role, I mean, it's looking at what is the bank's agency. So banks, for example, they don't control a company. Investors don't necessarily fully control the company, but they've got huge amounts of agency and influence and can both inform, educate, incentivize, or specifically kind of block and sometimes kind of veto certain kind of pathways for development from companies. And I think that what we're seeing now through certain ways that products are being created, things like sustainable linked loans in different ways, creating incentives for the good stuff and putting specific kind of barriers in place or even sort of, you know, hard stops for the things which we're wanting to avoid, just start to be able to kind of show up in those conversations in a much more proactive way, because it has to be a joint effort, but financial institutions have to kind of bear some of that heavy lifting of the load.
So for those, you know, I think we have a wide audience today. For those who are less familiar with these specific products, walk us through, you know, what would one of these sustainable products, you know, and offerings look like? Yeah,
so I mean, it can really range, and I think that it's less about here's a product and how it can be photocopied elsewhere, but looking at what is the bank's business model, what does its client's base look like? I mean, a very baseline kind of strategy might be, what if you were to, for example, and I think, I mean, well, Audrey will maybe talk later about a partnership for carbon accounting financials and being able to just like know where the carbon is on a balance sheet. You can start to identify, well, where are the clients doing something good within this sector, and where can you maybe connect them to some of the hotspots where those who are struggling a little bit, and say, why don't you just have a, you know, check in with these guys, because they've obviously figured something out. And some of those introductory networks through suppliers or client referrals can be massively sort of catalyzing in terms of balance sheets. So it can be really, you know, baseline level like that. There are specific things in pricing. So I remember Triodos was one of the first, was a green mortgage on the market, where you are linking interest rates to energy label. And then you're saying, well, actually for the discretionary additional amount that you might lend for retrofitting, then there'll be an extra discount. And we'll lend more specifically for houses which can get to as close to sort of a carbon neutral level, and less for those which are further away. So you can start to shift and sculpt some of the financial products. But it's also around sort of the general kind of actions of a bank. So what is the bank doing on its public policy side in terms of what it's asking for, which is really in support of that sustainability agenda, and what is maybe in conflict, and being able to kind of address that openly and honestly and resolve some of those tensions and conflicts.
That's really helpful. Thanks for walking us through that. And you've also advocated for perhaps a rating type of system for financial institutions. How are you thinking about that, and how might that work, and what would the incentives for financial institutions to participate, and who might administer these ratings?
Yeah, I mean, I think that in terms of ratings, there's ratings different things. So there's ratings already for the risk return element, but looking at broader impact, I think the first thing is about transparency. And about transparency is a vector for understanding. It's like, it's to help people understand. It's not to just throw loads of figures and people say, well, pick the info you want from that. It's really to be able to give stakeholders a real understanding of, like, this is how we're doing, this is how we're approaching these challenges, this is what we're trying with customers, this is the progress we've made year on year. That's some of the architecture within the UN Principles for Responsible Banking, which was set specifically, rather than just being a bar and you get a stamp. It's like, yep, you've done everything, but it's about a sort of a progressive ramp that you kind of say, well, yeah, you've got to be showing what it is you're doing, what the impacts are, and how you're progressing against those year on year. I think that what we really wanted to be able to see, though, is specific impact reports which go into the detail. I think the impact investing community through the GIN has been doing this for years. There's things like the Impact Management Project, trying to make sense of impact data. The World Benchmarking Alliance, I think now it's sort of turning attention to finance. We need some of this architecture to help investors, customers, and citizens understand. I want to understand the context of all of it, because once it gets into the billions and trillions, you can easily kind of lose things in the fog. You need to know, is this really aligning to the goals of climate? Is it really aligning to the goals of biodiversity? Is it really being able to support communities, vulnerable communities, with what they really need when they most need it? That's the kind of thing which I think is the driver, and then reputation risk and the reaction from stakeholders will help to drive the market in the right direction.
Thank you so much, James. That's terrific for us to just kind of lay out some of the issues. And I think it's a really nice pivot point to Audrey, because, James, you're really talking about, how do you increase transparency to really enable investors to make informed choices and unleash, more capital essentially toward climate adaptation. And Audrey, you've done some really interesting work on and surveying of your investor base at Morgan Stanley, and I wondered if you could just share some of the insights that you're finding about investor preferences at this point.
Sure, Claire, and thanks so much for having us here today. This is a really important conversation. We have definitely seen an increase, a real evolution, pretty dramatically over the past several years. When we started the Global Sustainable Finance Group back in 2009 at Morgan Stanley, it was really way before Wall Street was frankly really focusing on sustainable investing. And at the time, sustainable investing was something that maybe applied to about just over 10% of the market. And it was really seen as something where certain investors wanted to potentially avoid certain, problematic investment areas that they, didn't necessarily want to be personally invested in. What we've seen over the last number of years is an incredibly dramatic, really sort of hockey stick acceleration of interest in the field. Actually, most recently, we've seen that, as opposed to that around 1 out of every $10 in the United States, the most recent data from the USF shows that it is now a $17 trillion market, representing about 1 out of every $3 under professional management in the United States. And that investors there are saying that they are really caring about environmental issues or social issues as a part of their investment thesis. And I think the most important thing that really represents, Claire, is this increased awareness and this evolution over time of awareness that things like the environment or social issues, including social justice and income inequality and opportunity, are not for too long were considered as extra financial or non-financial factors, but these are absolutely fundamental to business, that these are material financial considerations. That James has said, especially something like climate change is such a mega macro trend that of course it is material to the business continuity of a business whose supply chain could at any moment be disrupted, the health and welfare of communities, obviously national economies, and even to the very stability of financial markets and financial institutions if we're not looking at this correctly. Right, so we've seen now that when we at the Morgan Stanley Institute for Sustainable Investing, we do regular polls of investors, and what we've seen is a steady increase. When we first did it about 7 years ago, I think 71% of people said they were interested in sustainable investing. May or may not know exactly what that even meant, but said they were interested. It's now 85%, and amongst the millennials, it's 95%. And I think that really that comes part and parcel with the fact that that climate change is, of course, such a macro trend. There was a recent evaluation by the Sustainability Accounting Standards Board, SASB, where I've had the pleasure of being on the board for a number of years, and it estimates that about 93% of the value of U.S. equity markets is exposed to climate change risk that is not currently reflected in what are today's required financial disclosures. So very much to James's point, again, whether or not you want to, quote, believe in the importance of climate change, whether you're a corporate leader, an investor, or a regulator, how can you not want transparency, disclosure, and investor protections around a material business impact that could affect 93% of the equity markets? I could go on and on, but I'll stop there for now.
No. I mean, that's tremendously helpful to just give us a sense of both the magnitude of interest, but also the potential capital at play. And I guess the bridge that I'd like to draw is how do you get and funnel a meaningful portion of that investment to the benefit of low-income communities, which is really what our conversation centers around today.
Mm-hmm.
You've spoken very eloquently about how climate adaptation really should be the core of community development types of investment, and I'm curious if you could just clarify for us what you really mean by that, and how climate adaptation could be woven into what I think we would all say are sort of the bread and butter issues related to community development at its core: housing, access to healthcare, et cetera.
Mm-hmm. Well, Claire, I think that's exactly right. For far too long, I think we've thought about, when people talk about ESG investing, environmental, social governance, factor investing, I think for too long people have thought about them in silos, right? There's the climate change plays, and then there's sort of social housing or other social plays, or maybe gender investing, and then there's good governance issues. And I think that if nothing else, 2020, the word of the year is really about confluence, right? I think this is a lot of people I know have talked about 2020 as this year where we've had cascading crises to deal with, but I really think it's more about a confluence of crises, right? We've seen extraordinary, devastating climate events, whether that be in Australia or California or in the South United States. I mean, really all over the globe. You've seen extraordinary weather events, the kind of which any one of which would be a tail event on a traditional risk manager's kind of probability curve. You've seen this cluster of climate extraordinary events. And you've seen the pandemic, and you've seen the racial reckoning. And I think for us to think that these are not all interconnected is just to be kidding ourselves. As James, and I'm sure as Mijin is going to talk about, it is absolutely no coincidence that when you look at the communities either most devastated by some of these extraordinary climate events or most impacted by COVID infections and COVID death rates, and affected by social injustice, undeniably, disproportionately, beyond any shadow of a doubt that this is beyond statistically significant. These are low-income communities and predominantly communities of color. And it's really, unfortunately, not too hard to understand why. When you think about the fact that, let's take, in the United States, low-income communities of color are more likely to live in places where there is less green space. More of their surfaces are paved, there's less trees, there's less open spaces, less green spaces, and shockingly, not at all shockingly, right? The temperatures of those neighborhoods are actually higher, up to 5 degrees higher in some cases, because you have these sort of brutal concrete jungles, as opposed to the communities that anyone who has a choice wants to live in, whether it's green and leafy and shady and lovely, right? And so it's not just an issue of loveliness, it's actually an issue of fundamental physical habitability of these neighborhoods for them to have some of those more climate-friendly issues. And then you have the cascade of effects, right? If you're living in one of these neighborhoods that has less greenery, higher temperatures, it's no accident that those are the same communities that are also suffering more heat-related distress health effects. Unfortunately, unfortunately, it's also the case that those are also the areas that have less easy access to walk-in, affordable, accessible preventative care and health care. Right? It's also no accident those are the neighborhoods that have less great access to convenient public transport and in terms of equitable transit-oriented development. And all of these those neighborhoods are also, especially low-income communities of color, are unfortunately far more likely to be located closer to industrial facilities that generate disproportionately high amounts of air pollution. And what we're seeing from, unfortunately, the COVID data is that if you live in an area with worse air quality, you're more likely to become susceptible and potentially have severe effects and not be able to recover from COVID. So what we're seeing is really this incredible vortex where, unfortunately, communities of color and communities that are low income are at higher risk from their occupations, that they can't do them virtually as we're all doing here from the comfort of our homes, being 120% effective without moving, right? They're first of all, they're just more exposed physically to the vulnerability. And then they're living in conditions with higher temperatures, with worse air quality, higher susceptibility to disease, and lower access to services. And so, I think as you think about the levers of influence that you have from the Fed, it's really amazing to think about CRA as this opportunity. If we are going to be helping proactively direct capital to say, CRA, from its foundings back in 1977, was focused on hey, let's not redline these communities, right? Let's make sure that these communities have access to credit and credit serve as a proxy for opportunity. I think that we need to make sure that as we do that, we're thinking about how are we actually making these neighborhoods not just of potential opportunity, but neighborhoods that are actually able to be healthy and thriving. And that's going to include thinking about the quality of energy that is in these houses, the air quality that is around them, the neighborhood quality in terms of green spaces, and the access to things like fresh and healthy food, like public transport. And frankly, all of those things that make for a thriving community.
So, Audrey, thank you for really weaving through frankly how closely correlated so many of the vulnerability factors are, and it can seem really daunting, right? Because as you noted, the CRA has been in effect since the 1970s. Since then, we have not seen a transformation. We have absolutely seen the power of CRA in promoting affordable housing and in having an impact in communities. But when we think about the scale of the challenges that we face and these communities face, it can be quickly kind of overwhelming, right? And I guess the question is, one, in your opinion, how might CRA be more have greater impact, even greater impact than it has had, and two, how best to marry a CRA with other private capital, because I think there is a real scale issue in terms of just the dollars and the enormity of the challenges ahead.
Right. Well, look, so I'm obviously not a policymaker or a regulator, so I'll leave it to the inspired leadership of you and David Erickson and Kevin to do that. But what I would say is, for Morgan Stanley, as we've thought about our community development finance investments and thought about partnering with with CDFIs and other community members, what we've really always thought about is, again, yes, from a reg perspective, there may be certain things that that any bank has to do to get credit, and of course we're going to do those. But we've always said, look, how can we think about how we can use this capital to really help kind of crowd in and create a multiplier effect? So, could we get credit for a vanilla affordable housing investment that thinks nothing about any of these other issues? Sure. But why? But what we always try to say is, how do we proactively say, let's use this investment as a way to say, look, we can invest in affordable housing project A or housing project B. If affordable housing project A has no additional services, none of these other considerations, and even if it would get equal credit, we are going to proactively choose housing project, B, where we're saying we're only going to do this if you actually bring in access to fresh and healthy foods in terms of a grocery store, or if you think about all the best, energy efficiency issues, or possibly even solar panels, or access to Wi-Fi, which I know the digital divide issues that we're seeing right now for children in poor neighborhoods. We thought that we had addressed a lot of those digital divide disparities through the Telecoms Act and the E-rate and access to the internet for schools and libraries, which is something that I was really proud to be able to work on back in the 90s when I was in the Clinton administration, but what that left out was homes. And when we are now seeing that every home is a school, that disparity is extraordinary. So I think thinking more, look, people live in their homes, right? And if we want to guarantee equality of opportunity to people who are already facing systemic challenges from the income and or from race or other systemic issues, we have to figure out how do we make those really, not just dwellings that have four walls and a roof, but real homes, right, that have access to true opportunity through access to high-speed internet, through through energy efficiency, through great air filtration, with access to to play space and green space, so that actually you can start to see improvements in health outcomes. The amazing research that's been done at Robert Wood Johnson and other places showing that your zip code is more determinative of your long-term health than your genetic code is either incredibly tragic or incredibly inspiring, because that means we should be able to change all those things. Right. So I think that the more that we can think about how do we use any tools we have, whether that's the carrot of an investment, and how as an individual or institution we choose this investment over that investment, or from a public policy perspective, how do we support and kind of encourage people towards those more holistic investments is incredibly important. And I think the encouraging thing that I would say to your point about how do we get scale and how do we get speed, the encouraging point is what we've definitely seen from private sector investors, again, whether that's millennials investing their first $5,000 for the first time in an account, or the largest institutions in the world. We've seen an extraordinary increase in investors wanting to align their investments with the things that they care most about. One of our recent polls, actually, interestingly, of investors and said, what are the thematic issues that you care about? Well, first of all, investors said, we don't want just general sustainability, right? We don't want just like an ESG index fund that said, yeah, it's good or better. We actually want to know what is the impact we're driving. And the three top areas that people were focused on was climate change, plastic waste reduction, and circular economy, right? Because people have realized that the take, use, throw away model is not working for anybody, especially low-income communities who tend to be closer to dumps and other forms of pollution. And then thirdly was economic opportunity. So as you see the sea change of now, more than 1 out of every $3 saying, I want my investment to be aligned with the things I care about, and the things I care about are climate change, pollution, and economic opportunity. I think there's never been a more promising time to try to really crowd in private sector capital alongside, the right public policy incentives and guidelines.
That's tremendously helpful, and we're going to return to that, I think, in our broader discussion, because I'd like each of you to hop in and with your perspective on what do you need to do specifically in order to create greater transparency and to kind of be able to tell the story of the impact of those dollars. Meejin, I'm going to turn to you, and I'm really interested. Audrey, I think, outlined really nicely for us the connections and really the how so many hurdles hang together in communities that are most vulnerable, whether it's health challenges, housing challenges, and of course climate challenges and vulnerabilities. But Meejin, I'm curious from your perspective. I mean, you've really written extensively and thought extensively about what a just transition looks like. So as we try to adapt to climate, how we can have equity as at the center of our considerations. And just to tee up, I think the transition to climate adaptation, there's a tension there. There's a tension built in because on the one hand, you have communities that are hardest hit, as we've heard today. On the other hand, it's costly to transition. It often requires economic dislocation of one sort or another, and that imposes short-term costs for communities that, in the medium and long term, certainly are better off. So, Meechin, I'd just love for you to share some of your thoughts about, at a high level, about what a just transition looks like and what really that means for the people who are living in the communities that are affected.
Sure, and thank you, Claire, and thank you all for having me here today. And I really appreciated James and Audrey's comments, and looking forward to our discussion. So I think there are a couple of points to make. One is that, while you talk about climate adaptation, we don't want to let go of mitigation, right? So it's still not too late to stop the worst impacts of climate change. And as we think about what we're investing in, what we're supporting, this is something that we should really take into consideration, right? Versus, continuing to invest in carbon lock-in infrastructure is not going to help us. But using that, redirecting that capital to creating a low carbon future is really what we need to be thinking about. So when we think about just transition, I think there are two, kind of fundamental questions that drive it. The first is, what are we transitioning into? Like, we keep talking about transitioning into a low carbon future, transitioning away from fossil fuels, but what does that really mean? And I think something that really gets lost in this discussion is that we have to create jobs at a very fundamental level, right? So when we think about all these issues that face, say, coal communities or oil and gas communities, the main issue is economic insecurity and whether they're being able to meet your material needs. And we have a history of unjust transition both in the US and globally where workers and communities in declining industries have not been transitioned into an economic future that is just, right? We can think about deindustrialization, we can think about logging, we can think about the textile industry in the Northeast. All of these industries have gone away, and what has happened is that these workers and communities are largely left behind. So it's not just increased unemployment rates, right? Like, if we can think about now, a lot of small communities across the country are monodependent upon either a coal-fired power plants or a coal mine or oil and gas drilling. And when those activities go away, they lose all their tax bases for things like schools, for infrastructure, for basic social services. So that's the one question of what are we transitioning into? So as we're transitioning away from fossil fuels, we really need to think about what is this economic activity that we are creating and developing. And it's not just renewable energy generation, right? It's not just a clean energy economy. It's not just energy efficiency. I think we have to rethink what we mean by low carbon sectors. So for instance, the care economy is one that will, that demand will be increasing, particularly as our populations age. And we know that we need to invest in not just ensuring that those jobs are created, but that they are good jobs, right? So we keep talking about these conflating crises. One of them is inequality, right? We have a massive crisis of inequality. And part of what's driving that is that we have total wage stagnation. So, it all ties together, right? When we think about who are essential workers, a lot of them are service sector workers. That sector is notoriously underpaid and exploited. And those largely are workers of color, right? So when we think about, as we're creating these new low carbon sectors, we need to ensure that the jobs that we are creating are good jobs. And that kind of leads into why it has to be just, because the issue is that we are continuing these exploitative systems that actually are increasing inequality, resulting in wage stagnation. And we, layer on top of that this global pandemic that has put so many people at economic risk, right? So as we transition away from these things into what is ultimately, at the very basic level, a better and more just future, right? I think we could all agree that there are so many things that are unjust, and we don't want to continue these practices, right? We don't want to bring inequality into our future. And the only way to really tackle that is to understand that we are currently in an unjust system. And so as we transition into a low carbon future, it's not about creating a bunch of solar jobs that are poorly paid, that only exist in certain areas, but really understanding what are we creating and how are we making the future better, right? How are we making people's lives better? And without that kind of discussion, without that kind of analysis, I think we will just be replicating the mistakes of the past. So perhaps we will, burn fossil fuels less, but we'll have these patterns of inequality. We will continue to exacerbate inequality, racial, economic, gender, all of those things. So when we think about, this idea of cost, for instance, I think we have to really think about what do we mean by cost, right? So we will pay either way. Either we will pay for, addressing the worst impacts of the climate crisis. Hurricane Harvey, for instance, cost $125 billion. Or we can invest in a low carbon future that is just, right? So when we think about, balancing these costs, I think we really need to rethink what we mean by costs and who is bearing these costs. And in that calculation, I think investing in a just transition is a much more financially sound decision.
It's a really interesting point that you raise about the costs, right? And I don't think that that's a point that's really frankly well understood or broadly understood. And so, from your perspective, I mean, is that an issue is it a communications issue? And how do you overcome that? Because I think part of what you've written about with respect to outlining a just transition is that you need to achieve a consensus. There needs to be some broad support. And I'm curious if you've seen examples either at the community level or more broadly where you could point to examples of communities that have grappled with these issues, that have built a consensus, and frankly have articulated kind of the cost if we don't take this shift now. We're going to really pay a greater price later, because those could be interesting examples to draw on.
Yeah, I mean, to be honest, we are not great at proactive planning, particularly in the U.S. So part of the issue of just transition is that if we plan now, in 10 years, we actually will have a just transition. But what you're seeing now is kind of like the last dying gasp of this industry that is kind of, really digging their nails in and trying to extract every last element of coal, oil, and gas. I can talk a little bit about an example that I think is a good and instructive one. About Diablo Canyon, which is in Northern California. It's a nuclear power plant. And the operating utility, PG&E, decided not to renew their operating license because the cost of solar was so cheap that it became economically unviable to continue the nuclear power plant. So it's proactive in the sense that it's not happening tomorrow, but it will be in a 7 to 8 year horizon. And so when it became clear that Diablo Canyon would not continue, a diverse coalition came together that included PG&E and included the union that represented the workers in the plant, IBEW, the International Brotherhood of Electrical Workers, local community groups, because a lot of it's in San Luis Obispo. A lot of the community, the money that comes from the nuclear power plant really funds things like schools and infrastructure, and environmental organizations and anti-nuclear organizations. And they came together with this plan that had a worker transition plan and had a community transition plan, and then also required replacement, that you would replace the nuclear power with renewable energy. They took that plan to the California Public Utilities Commission, which approved parts of it. So a diminished worker retention plan, no support for the community, and no guarantee that the nuclear energy would be replaced by renewables. The reason why you need a diverse coalition and kind of from the ground up planning is that instead of accepting that reduced and diminished package, the coalition went to the California State Legislature, and they introduced a bill forcing the PUC to adopt the original transition plan, which is much more just and much better for everybody. So now, when Diablo Canyon retires, they have a worker retention plan that will have a tax revenue replacement for the community, and they also have a guaranteed replacement of renewable energy to replace that nuclear energy. And I think that kind of thing is what we want to do. We want to really engage in more proactive planning. In contrast, for instance, there was a refinery that blew up outside Philadelphia, and because they were in crisis, right, they had to immediately deal with this consequence. Workers then immediately turn to environmentalists, start to fight, because everybody is in a moment of stress and a moment of, there are really immediate needs that are not being met. So a much better approach is that understanding that we have to really decline this fossil fuel infrastructure. We know that now. So now we can begin the planning processes so people don't end up making decisions in crises.
Thank you for those examples. I think that really helps, clarify, the parameters for our audience. I'm curious. Before we turn to our broader discussion, just follow up for you. You made a point about the U.S. sort of, maybe not excelling at long-term planning. And there are a myriad of factors, of course. Short-term political cycles certainly factor in, among other factors. But I'm curious about international examples that you could draw on, and maybe learnings that we might be able to apply or at least consider. Are there examples that you'd say, hey, this country got it right?
I think globally we are starting to really transition, but I can point to the Ruhr region in Germany, which was at its peak a real steel manufacturing and coal mining region. And, due to global factors, steel manufacturing and coal mining became less economically viable. So they really invested in the region to kind of redevelop it into something new. And it has now, they stopped the last subsidy for coal mining, I think, in 2018. and steel manufacturing has gone for a long time. They still do a little bit of hard rock mining, but in general, it is a region that has transitioned away from fossil fuel infrastructure. A couple of lessons, though, is that one, Germany has a much stronger social safety net than the U.S. So, for instance, the pandemic is a great example of, we have a global health pandemic and millions of people lost their jobs and they also lost their health insurance. To me, it makes zero sense. So in Germany, for instance, when a coal miner were to lose their job, they still have social supports, right? So they're not immediately plunged into despair. The second thing is, in fact, long-term planning, right? It took 50 years, which we don't have 50 years, but I think that we can learn a lot so that we can do a lot in a much shorter timeline. But it is the idea that you have a long-term horizon. So some things that really prevent it, in addition to our short-term political cycles, is this continual need for quarterly profits, right? That really drives a very short-term thinking. But we have to we have to redevelop our economy, right? That is not something you can do within one quarter. So I think if we can really expand our time and planning horizons, we can think more broadly, more expansively. So as has been mentioned before, energy efficiency retrofits is as an example that is both a great job creator and also will reduce emissions and also makes people's homes healthier. But you need to have a long-term, like 7 to 8 year timeline for that to become economically viable. And that was true for a lot of our fossil fuel infrastructure. So I think, understanding regional development takes years, understanding that, this economic transformation will take a long time, but it's better not just for our economy, but for our society going forward. In fact, we have no choice except to really think about this planning and redevelopment on a long-term scale.
You raise an excellent point. I really do appreciate that example, the international example, and folding it in. And I think that you're pointing out a really important element, which is that the jobs that are going to be created, to build resilience and ultimately adaptation, are going to require new skills. And I think that's another conversation about how do we train and reskill. But I wanted to broaden the discussion across our panelists, because I think that we've had some interesting themes that have emerged in the discussion so far, including kind of this time horizon issue. Sometimes what's most profitable in the short term, of course, is not socially optimal in the longer term. Audrey, I'm curious from your perspective, though, because you really have articulated that, climate adaptation and investment is really can be a very important part of a firm's brand. And of course, you have invested significantly at Morgan Stanley in initiatives to aid transition. And so I'd like to just get your thoughts on this time horizon issue and how the appetites of investors may be harnessed for adaptation purposes.
Yeah, sure, Claire. So look, I think there's a couple of things. One is certainly, as Megan said, if you are a rational and strategic investor, right, you are definitely going to think about what are these strategic investments in the ounce of prevention instead of paying for the pound of cure. But in addition to that, I think what we're increasingly seeing is, first of all, a changing recognition that this sort of long-term, short-term thinking is not really tenable anymore, right? I mean, just look at this year, right? I mean, you cannot say, oh, climate change is a thing that I should care about for my grandkids' sake or for my kids' sake. No, climate change is something you need to care about this quarter, this 13-week period for your earnings, because if your business is disrupted by a wildfire or a tsunami or a hurricane or a pandemic, that is a this quarter issue. So first of all, I think we have to, and I think we, have really gotten to that point where people are finally understanding that climate change and, racial reckoning and the social injustice and all the knock-on costs and tolls and, that causes, even if you were to be sort of just very narrowly, clinically, economically focused on those issues, besides the broader reasons why you should care about those issues, those are a today issue. Those are a here and now issue. I think the other thing that has really contributed to my optimism, such as one can find in these kinds of years, my optimism that we are seeing a secular change and not just sort of a moment, is that there's growing awareness and understanding that actually it is not a situation where you've got the positive financial case versus the positive environmental or social case, right? That not only do environmental issues and social issues, quote, matter to business, but you are actually, being a more prudent investor if you are thinking about these, right? So for when we started this, for a long time, people said, Audrey, environmental, social stuff. I care about that a lot. I'd love to care about it in my business, but it's just, I need to deal with the shareholder. And we spent a lot of time arguing as to whether there was a discount to returns if you chose to invest and consider the issues of environment or society. So we actually said, look, let's just do the work, right? Let's crunch the numbers. And so we most recently put out a study where we looked at 11,000 different investment strategies over 15 years performance and plotted the traditional strategies against the sustainable strategies. And what you saw when you looked at the returns is basically the return curves were right on top of each other. So there was actually no discount to the returns for the sustainable strategies, where there were over 15 years of performance. I realized sort of like, quarter by quarter, year by year, they're going the same. Where there was a statistically significant difference was in the downside volatility. But the sustainable investment strategies actually had up to a 20 percentage point lower downside volatility than the traditional strategies, right? Which just means that if you're actually thinking about the environment, you're thinking about social issues and good governance, you're probably actually going to spot quicker some of these things that could lead to accidents, to legal settlements, to all sorts of other costs of doing business. And frankly, I've never met an investor who said, I am uninterested in that investment option, Audrey, that has the same return and lower downside volatility. But to zoom in even a little bit more, if you just look at 2019 and, the first 3 quarters of 2020, so through end of September, in 2019, you generally had markets, going up. The sustainable strategies actually in that bull market, the sustainable strategies actually outperformed the traditional strategies by, I think it was 2.8 percentage points. In the markets of 2020, in the first 9 months, what you actually saw is once again the sustainable strategies actually outperformed the traditional strategies. The sustainable strategies actually ended up at the end of September, they were 4.05% in the black, whereas the traditional strategies were about 2.25% in the red. And so again, I think that, at some point you can have big strategic conversations with people where you can just say, look, what do you want your portfolio to do? Do you want your portfolio to be de-risked for environmental and social risk? Do you want your portfolio to be proactive about thinking about future opportunities? Because all the evidence that we're saying shows that it is both alpha generative potentially and beta reductive. So I think that has helped kind of change the conversation a bit in terms of time frame. It's here right now.
That's really helpful. And I wonder too, and James, I'm going to fold you in and draw you back into the conversation here. I'm curious about, you both have talked about measurement. You've talked about, the impact of the investments. So both Audrey, to the point that you just made that, you're not bearing actually any loss. You're in fact actually, this is a profit enhancing strategy to be diversified and to be, eco-conscious in your investment strategy. Are we there where we need to be, though, in terms of the transparency for investors, the measures that we would need to take in order to really clarify, and be able to differentiate across investments? Are we where we need to be in terms of telling that story of the impact of the investment? And James, I'm curious because you referenced, efforts by the GIN and others. I'd love your thoughts on kind of where those measurement standards and tools are and where they should be and how we get to where we need to be.
Yeah, thanks. I think that there is a lot of complexity in it. One of the things is, in terms of some of the inequality, it's baked into some of the asymmetry in the financial system. If you take, for example, there was a 7% figure that Kevin quoted in the introduction, comes from a Brookings Institute report. 7% GDP loss for low-income communities. In the same report, it was talking about maybe 10% average GDP loss in a 9-degree C over post-industrial era climate. That's kind of clearly, it's like, that just feels too sanguine. It's like, it was a 38% loss in GDP, I think, in the US in the first quarter. It's just like 7%. Does that mean like 7% slightly lower quality of life? It clearly doesn't mean that, because some of those other factors, which I think there's been such good articulation of, don't necessarily get translated. It doesn't count the cost of, whether in climate terms of the loss of well-being, of health, and undermining, the livability of cities and communities. I think that therefore there's some of the things that being able to sort of like offset one thing against another. We're not putting prices of life in COVID when making political decisions. The early adopter countries like New Zealand were not making it on primarily economic factors. You're having this two-dimensional decision matrix. And likewise, some of these connections between what we're investing in today and these impacts in the future. Sometimes, as Audrey said, that things are aligned, and certain parts of the capital markets, you can kind of say, yeah, it's paying to do these strategies right now. But there are some points where there is this asymmetry. If you're financing shale right now, an exploration of fossil fuels, which is not aligned with the future, then in the same way that there's this strange connection that we've just learnt about loss of habitats for animals, some part of the world leads to zoonotic pandemics, leads to masks and economic shutdown. Likewise, those loans, which may or may not be, from a financial point of view penalized, are exactly the things which are going to lead to these negative impacts down the line. And it's that kind of asymmetry which we need to kind of think about. Is it going to be ever fully corrected by repricing through regulation? Well, I'd argue there is a strong case for trying to reprice some of this stuff, not just in the capital that banks hold against different loan portfolios, but where's the contribution to the commons? Where is the polluter pays principle applied to finance within this? For being able to say, look, in the same way we don't fully now understand all of the implications of COVID, but we know what it does to the economy. We can start to say, well, we need to take action in a precautionary way for some of this activity and reprice it, and ensure that we're as transparent as possible, because we don't have all the answers and we need to learn as we go on, and enable a different type of dialogue between regulators, society, financial institutions, to be able to kind of moderate and mediate this whole issue.
It's interesting because, and thank you for that. I mean, I think that this issue of frankly, what is not accounted for and is not priced in is an important and compelling point. I think that when you think broadly, and I'm speaking very bluntly here, you can think about the tools at our disposal, and you can kind of put them into two buckets: the carrots and the sticks, right? And from Audrey, I think you articulated there are many carrots, and I think there's a better articulation of the carrots. That you're not paying, the investor isn't paying a price necessarily and taking a green adaptive investment strategy. From the stick perspective, and I realize my comments are my own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System. So with that disclaimer, I'm curious, what role does supervision, and does the regulatory regime, fit in here? And from your perspective, in your opinion, where are we and where should we be? And James, I'm going to put you on the spot first, but then I'm going to inflict this question on all of our panelists.
Yeah, well, I mean, I think that very specifically adopting the precautionary principle and saying, so at the very basic kind of line, there's a realignment of capital risks against things which have got these macro risks. So things which are fueling the problems, we need to be able to, for this, if it's undermining future financial stability, then under the mandate of protecting financial stability, there needs to be a counterbalancing sort of correction within capital. Likewise, if a large bank makes a loan over here in the US, then that's increasing the climate risk for a community bank somewhere in sub-Saharan Africa. Where's the compensatory mechanism for rebalancing within the international financial system? I think that in terms of the overall management, we need to consider what is it that the regulators can specifically kind of do within the regulatory context of what they kind of have with banks and investors, to say, what is your timeline? And if you're not holding to that timeline in terms of not just your own risk, but for that impact overall, then what's the carrots and what's the sticks, as you said? For the carrots, we're depleting our carrots. To put it, I mean, California spent over $1 billion this year in firefighting. In terms of anything for the community, that is waste. It is depleting public expenditure, being able to pump prime, de-risk the kind of investment we're going to need to create the climate solutions of the future that banks and investors are going to say, well, we'll come in when the markets are more mature and when there's a commercial business case. There's still in all the scenarios so much technology and approaches which are going to need massive amounts of this kind of more risk capital to blend with if we're ever going to have any hope of being able to reach the kind of climate resilience within communities. So it's also those kind of systemic loops that regulators have to play a role within as well. And that's really tricky because we do not have all the data. We're never going to have all the data. It's about being able to apply some of these precautionary principles, and that's a massive cultural change.
That's really helpful. Thank you, James. And Audrey, I'm going to kick it over to you next for your thoughts and reactions to James's comments and my questions.
Yeah, no, look, I would underscore a lot of things that James said, right? Which is that it is so clear that climate change and climate risk and the need for action is absolutely not a political or partisan issue, right? This is fundamentally, an issue for us all collectively as a planet. And it is, and the way to kind of make that stick inside financial circles and investment circles is to realize it is a financial risk, right? Again, you could just call it factor X, right? But if there's some factor X that impacts 93% of the U.S. equity markets already today and is not currently part of disclosures for investors to be able to judge accurately, that's just not prudent, right? And so I think, to begin with, if nothing else, just from a matter of sort of prudent oversight, investors should know what are the material risks that affect any possible investment. So I think that, again, through the work of the Financial Stability Board, TCFD, the Network for Greening the Financial System, where I think the latest count is something like 75 central banks from around the world are part of NGFS saying, yeah, this is material, we got to deal with it. That is, an incredibly important building block. I think, as James said also, that, individual financial institutions, like, we are increasingly saying, yes, we're not, the frontline company that may be, creating a lot of emissions. I mean, sure, a number of years ago, we said that we as a company would be carbon neutral by 2022. We're going to source our energy from renewable energy sources. And that's terrific. And we're proud to do that. But at the end of the day, our carbon footprint as, bankers sitting in a building is not going to change the world. But what's much more material is our financing, right? And so this past summer, we were very proud to be the first major U.S. bank to say that across our business, that we are going to be net carbon zero by 2050 in line with the Paris Accords. Again, that's even probably not enough, and we all need to do more and do it faster. But we are on this journey, right? So that's why James also mentioned the PCAF, the Partnership for Carbon Accounting Financials, because we have to be able, as a global financial system, to be able to develop common understanding around metrics and measurement so that we can actually have transparency and so that you can compare. Because it is a problem right now, right? If you have some banks saying that they're going to focus on, net carbon zero and some banks not, and, a project that may have a challenging carbon profile can't get funding somewhere, they can just go down the line and get, funding from any number of financial institutions. And until there's actually a common sort of understanding of what does this mean? What, if this project has, creates the following risks, whether that be, carbon or any other kind, how should that be affected into the cost of capital, right? Like, we have to have that be explicit versus implicit. And, I think really, we've had amazing conversations with all of our colleagues in risk, including our chief risk officer, right? Because when we said that we were going to think about being net zero across all of our financing by 2050 in line with Paris, that meant that, that's not just something you can say. That's not something that can just be sort of like a policy wish. That's something where your chief risk officer and the entire risk operations has to say, okay, we are actually going to, we have to create a model, right? We have to create a framework for how we're going to measure, disclose, understand, and risk rate things by their carbon intensity. And, the only way that we're going to get there collectively as a planet, if, exactly as James said, if we are really understanding all the interconnections Unfortunately, the planet and, parts per million of carbon don't know national boundaries. They don't care about corporate, responsibility by one individual player or not. It's just a macro, just the way that unfortunately COVID-19 doesn't care about national borders and, politics. It's just going to spread, and we have to have collective action. And you can't get collective action unless you have commonly agreed upon metrics, transparency, and accountability.
Thank you for that, and that is extremely helpful in kind of, I think, our collective understanding of kind of where we are and kind of what needs to happen next. But I think for all of our listeners, just even understanding some of those accounting metrics and then also the regulatory elements. I appreciate your having, both of you having articulated that. Meejin, I want to turn to you to delve a little bit more deeply into, the more micro level and the communities that are disparately impacted. Going back to the top of this webinar. And I'm curious, as a society, others on this webinar have noted that, as have you, that our social safety net in the U.S. is not, it looks different than in European societies. And so when you look to international models, that can create some stickiness in the U.S. I'm curious from your perspective, as we think about this transition, are there principles to a framework that we could kind of think about, communities that are facing these challenges and the most acute climate challenges? Do we have even the beginning of kind of a common framework of there's going to be a job aspect, there's going to be a health aspect, there's going to be a compensatory aspect? Do you feel like we have a common understanding and a common language for even approaching in a systematic way how we might start to think about a policy that would be formulated to help these communities transition?
Yeah, and I mean, I would say it's not just that our social safety net looks different. Our social safety net is virtually non-existent. So I would.
Yeah, that was my euphemism.
Yeah, it's a nice way of saying it. Yeah, but we really don't have a safety net in this country. I think there are two things that I could talk about. One is that there was kind of a coalescence around kind of climate policy now at the national level around what we call standards, investment, and justice. So standards meaning, setting carbon targets of neutrality, net neutral by 2040. Investment is direct investment in both a low carbon future and also into what we call environmental justice communities. So communities that bear a disproportionate environmental burden that are almost exclusively low income and communities of color. And then the justice component. So really understanding that, race, class, and, all these marginalities are integrated into climate change. And some research that we've done is what we with our work with a professor at USC named Manuel Pastor, and we really looked at kind of, if you wanted to kind of formulate a just transition policy, what would be some guiding, what we call pillars. So we have 4 pillars that we've kind of come up with, and I can just briefly run through them. One is, we really need a strong governmental support. So to your point, Claire, one is just through like these direct social safety net measures, right? When people lose their jobs, there are some immediate needs that need to be met. But also in terms of the scale and timeline of planning is really best done, we think, in the public sector. The second is a dedicated funding stream. So if we think about previous examples, one of transition assistance, one of the issues is that they have stop and start funding. And you can't really plan a program, you can't really plan transition if you don't have consistent funding levels. The third is a diverse and strong coalition. So I think the Diablo Canyon example that I gave earlier is really an example of why we need multiple people involved. We need it to be, from the ground up, and we need it to, coalitions to stick together and really drive these planning processes. And the last one is economic diversification. So, part of the issue that we have now is that we've become so mono-dependent upon fossil fuels that as we think about moving away, we have created this system of communities across the country that if you transition away from fossil fuels, they will be literally left with no other economic opportunity. So we really, as we move forward, the best way to have a healthy economy and a healthy society is we diversify these local economies so that they're not mono-dependent upon one industry. And, I think when we talk about it, it seems very daunting, but I think that, it's not, we can do this with a lot of existing tools and instruments that we have now. It's just a question of prioritizing them and really, I keep saying is scale, right? With the scale of transformation, the scale of investment, the scale of effort really needs to be on a much larger scale than we have seen now.
So, to that point, that we need this to happen on a much larger scale. What's the inflection point? Kind of what's the delta? So, Audrey, I think you've clarified for us that there has been, in essence, I don't know if a tipping point is the correct label for it, but really a more broad understanding among investors that the returns are good. We're not sacrificing. From this consensus perspective, Meejin, I'm curious, what will drive that in your view?
I mean, I think now we have this point where we will need a massive stimulus to deal with the economic consequences of the coronavirus pandemic, right? To me, that is we are really at a pivot point where we can do the investment that we need to, start seeding a just transition, or we can just double down on our extractive economy. I think that the scale of investment that we will need for the economic recession recovery will be in the trillions, right? That's a scale of climate funding that we have never seen before. And it's something that has become increasingly accepted, right? President-elect Biden has said $2 trillion, 40% of which will go to what we call frontline communities, those that would be hit first and worst for the impacts of climate change. So I think what we have to really do is mobilize this momentum now, and even with the election is over, but the organizing doesn't stop. So putting pressure on our electeds and our regulators and everyone to really understand that we're not talking about incremental change. Like, we have passed the point of incremental change. We really need large structural change. And now is a moment where we also are facing a really massive economic recession that will come because of the coronavirus pandemic. So we have this moment where we can really invest in our future or double down on our past. And I think, there's no option for us except for investing in our future.
I think what's been, thank you for that, and I think for each of you, what's so interesting is you're not new to the climate discussion. Any of you, you've been immersed in the issues that we're grappling with for some time, and despite the gravity of the issues facing particularly low-income communities and communities of color, all three of you are remarkably optimistic people. And I think, Audrey, you actually stated that earlier today. So I want to offer each of you a couple of minutes to just talk about why you're optimistic, and in terms of thinking about, Meejin, I think you've quite nicely articulated that we are at this crossroads in a sense, where there's real need for some decision making and harnessing the best, albeit imperfect, evidence, as James noted. So two questions quickly for each of you. One, why are you optimistic? What are you most optimistic about? Whether it's an example of a recent kind of innovation that you've seen, coalitions that you see kind of bubbling up, and what your priorities for 2021, what you think they should be in terms of just a climate agenda as it impacts low-income places. So, Meejin, I'm going to go in reverse order. I'm going to start with you, and then turn to Audrey, and then James.
Great. Thank you, Claire. And thank you again, everyone, for this opportunity. I really appreciate that you think I'm optimistic, because most of my students and people that I talk to are like, all you talk about is why everything is so terrible. Everything is kind of terrible. But I guess maybe one point I could think of in terms of optimism is that, 10 years ago, we were having a very different conversation about the climate, right? It was about maybe renewable energy will be good. We don't really know, blah, blah, blah. I mean, now we're talking about, the fact that we're, mainstreaming net zero carbon emissions is a huge shift. It is a tremendous shift. And I think when you see, for instance, the youth climate movement, their demands are so far ahead of what we had been asking for before. I think it's really inspiring. 40% investment in frontline communities would have been unheard of 10 years ago. So I think one point of optimism is that the conversations that we're having now, I actually do think will address the worst impact. Will really help us put us on a path to stop the worst impacts of the climate crisis. In terms of priorities for 2021, I think the equity piece is going to be key, right? We have largely, our climate policy in the U.S. has largely been technocratic and focused only on emissions reductions. But as you've heard today, right, the social and economic issues of climate change cannot be separated out from greenhouse gas emissions reductions. So I think ensuring, that equity and justice are at the forefront of the climate discussions is a real priority. Again, if we're, an unjust transition is not acceptable, right? We really have to force and make sure that that equity and justice do not get left behind in the race for emissions reductions.
Thank you for that. Really helps us to kind of focus our attention. So I appreciate your remarks. Audrey, over to you.
Oh golly, well I think like mentioned, I'd say I certainly at least try to be optimistic, because I'm not sure how you make it through this year without at least trying to be optimistic. And I guess I would say where I find the optimism is in a couple of things. One is that as a result of these crises, that we do seem to have really gotten everyone's attention to understand why all of these issues are not in the realm of either fringe or lovely or something to be left to government or philanthropy. That these are central issues to business, to investors. They will disrupt your business. They will disrupt your livelihood. They will disrupt your economy if you do not take action. And so, unfortunately, I think that as human beings, we tend to need a burning platform. And unfortunately, 2020 is an incredibly hot burning platform that says we have to deal with these issues. It has also been, I think, an incredible awakening for people that, again, that not just that climate change is a material issue, but that social issues really are a burning issue, a burning platform for businesses as well. Again, to sort of look on the positive and the bright side, I'll give people at least one piece of encouraging data around gender equity that we've been able to research, right? That we actually compared companies. When you look at the companies that are actually in the top sort of performers in terms of gender equity, not just having a couple women on the board, but board executives throughout the organization, they financially consistently outperform the companies that are on the lower end spectrum of gender equity. So that's just one example of where doing the quote right thing on a social issue actually helps drive innovation, it helps drive productivity, it helps drive retention, and it helps drive earnings. So I think that's, as we get this increasing awareness of the materiality, the severity, the necessity of thinking about all these issues as business issues and some proof of the upside, that's good. I guess the other reason that I'm optimistic is around innovation, right? I mean, look, what is the history of the United States? What is the history of civilization on the planet, right? It's all been about improving quality of life through innovation and finding new solutions that didn't exist. Along the way, we invent new problems that never existed, right? Like we've actually invented in our lifetime the problem of plastic waste, right? Plastic literally didn't exist, at the beginning of the last century, and we have created this massive problem. But that means that we actually have all the tools of innovation, of science, of R&D, of mass production, of policy, of changing consumer habits to fix it. So I do believe that innovation has to be one of the things that we look to as a source for hope. And then I think also I would just say, as Mijin mentioned, the societal awareness and focus today, right? I think that clearly our generations have messed things up a whole heck of a lot, and we're relying on the next generations to help us out of the problem. And all indications are that they care about this passionately, right? That millennials and Gen Zers are 3 times more likely to pick their job and their career based on something that can have a positive social impact, and they're also twice as likely to choose a product, whether that's coffee or chapstick or an investment product, based on positive impact, and they're also twice as likely to boycott. So, you put all those things together, but I think I would say the biggest priority for 21 and going forward is we can't relax because we can find glimmers of hope for optimism, right? This means it's great that there's glimmers of hope for optimism, but unless we push that and scale that and make it, imperative for everyone across all businesses and industries and companies and countries, we are not going to get there in time, right? Again, if this were 50 years ago and we looked at all the data that we saw 50 years ago, maybe we'd have a chance to kind of think about this, in incremental. But exactly as Mika said, we're beyond the point of being able to rely on incremental improvement or even incremental innovation. We've got to figure out a way to really sort of radically shift the direction of the curve.
I'm going to call you half optimistic.
I'm optimistic that optimism can help us get there.
Indeed. And innovation, I would underscore your points about innovation. Thanks, Audrey. Over to you, James.
Yeah, thank you. And just to say, I mean, really enjoyed all the contributions in your questions, Claire. I'd say my sources of optimism has changed. I financed my first wind turbine 21 years ago, I think it was now. And back then, things were called alternative energy. And I remember kind of reflecting probably about 10 years ago that, no one's calling it alternative anymore. And that's really, I think that's really great. And at the same time, if you look across sustainable development goals, you look at the kind of the issues right now, it's not necessarily the technology gap, but it's about how do we relate to one another from individuals, businesses, how do we form those relationships and contracts in different ways in order for new forms of genuine value to be created as opposed to extracted. And I think that the source of optimism is just remembering what the money and the financial system is. I mean, it was created by humans, therefore it is a perpetual, collective, subjective reality. We invented it, we can reinvent it at any moment. And moments like COVID, where we suddenly, in a very stark way, get this kind of, this is the balance between human life and well-being pitted against economy, and we can make different types of decisions around that, leads to a different type of consciousness. It leads to a different type of conversation, leads to different types of decision logic. And I think that can flow in quite quickly into how financial institutions can redesign themselves, reconnect to what their purpose is. I mean, from Meaden's examples around job creation and being able to think about helping companies to transition, there's some amazing transferable skills from brilliant people in the financial services industry who could really be applying themselves to managing some of those societal risks and how to make that work for society rather than only protecting what they know. And that's the kind of the point, the fulcrum that we're on right now. And I think that because there is this increase in inequality, especially in consciousness, especially from younger people kind of entering workforce right now, I think that offers a lot of hope and a lot of new potential.
So I'm gonna hold you to the same standards as everyone else. What should our priority for 2021 be?
The priority for 2021.
Yeah.
I think that the European Union has, just to give one story, has spent quite a lot of time being able to define a taxonomy for sustainable finance. And I think, taxonomies aren't a panacea, but they're really quite useful in being able to kind of sort out, it's like, what is this class of thing which we can all agree has got certain properties and we can make decisions based upon it. If you're really going to be, if you want to really support the sort of the acceleration of sustainability and things which are doing good, you probably need to kind of focus first on, well, what are the things which are doing significant harm right now, so that you can excise those, so that you can use that in an instrument for channeling those trillions from the government, so that you can use it for being the policy and the parameters in which central banks and Federal Reserve can use for corporate bond purchases, so that you can use it for certain credit guidance to say these things, you can't do those anymore, so that you can use it for development banks, infrastructure banks to be able to say, here is how we're going to be investing to de-risk these priority sectors. So I think some of that coming together in a US-based taxonomy system to underpin some of the things for the sustainable priorities could be a really, it's only an enabling tool, but I think it might help go a long way for 2021.
Really, really helpful. Thank you for sharing those thoughts. And I want to just thank all of our panelists for really your insights today. We have covered quite a wide range of topics, but we'll look forward to inviting you all back, because I think that we could easily spend another hour and a half or a day and a half, really digging more deeply into each of these related topics. Thank you for your remarks. Thank you for your inquisitiveness and really the wide range of issues that we covered. I'm going to turn over the floor to David Erickson for some concluding comments.
Thank you, Claire. And wow, I am just so excited that we recorded that, because I'm going to watch it 2 or 3 more times, because I felt like it was just, I couldn't keep up with the insights and the great thinking from the panelists. Claire, you did such a great job leading that discussion, and thank you to all the panelists. I think from James's first comment to the end, his first comment talking about banks as agents, to the last comments talking about sort of the banking and finance system as a human construct that sort of serves certain objectives that we have control over. Those of us here in the United States are about to celebrate Thanksgiving next week, and that means all the Christmas movies are around the corner. And I couldn't help but be thinking about Frank Capra's movie, It's a Wonderful Life, where George Bailey is a banker in a small town in upstate New York, using the savings of that community to sort of fund primarily home ownership to the low-income immigrant community that lives there, and unleash the potential of that community in a powerful way. And to think about how bankers as agents can help in this process, and the allied investments that happen with other organizations like community development financial institutions is really on my mind now. And I think if Capra were alive and he were remaking that movie, it would star Audrey Choi as the banker, who really sort of reminds us that climate risk is layered on top of health risk and social risk and economic risk as well. And as she's demonstrated with some of the data that she's been able to collect, that sort of thinking is not something that that is a penalty in terms of your investment strategy. In fact, even in times of crisis, it can be a guard or an insurance policy against downstream risk. So that's just so powerful. And Meejin, I think you're very optimistic. I want to talk to your students about that. But the piece that I really take away from your comments was that, either way we pay. We either don't prepare for this and we pay for the downstream consequences, whether it's Hurricane Floyd or the $1 billion that James mentioned in terms of firefighting here in California. Those are consequences that you cannot avoid, and they're expensive. Or we can invest upstream and make communities more resilient in the first place. And think about that just transition that really focuses on those upstream investments that makes those communities more economically resilient, more health resilient, more socially resilient, and more climate resilient. And so I just think there really is a confluence of factors happening here in this conversation today and in the world today. So again, I want to thank all of the speakers on today's webinar. I want to thank the Climate Safe Lending Network for their collaboration in this important event. I want to remind everybody again, I'm going back to the website to sort of take a look at this recording that will be up in a few days. It will be on our website, the New York Fed event website. Please stay engaged with us at the New York Fed. Sign up for our in-review newsletter and follow us on social media. Our handle is @NewYorkFed, all one word. Thank you for all attending this important issue. Please stay safe and have a happy Thanksgiving.